Well, it's that time of the year where we extensively discuss the theme and ideate about the big idea for the coming financial year. It's time for Voyage 2022. After 2 years of twists and turns and peak and turfs, one thing is very evident, which is resilience. And that is going to be the theme of this year's voyage, which is navigating the volatility with a lot of resilience. It's all about navigating, isn't it? So let's take the voyage journey forward with Bala and with Mahesh and talk about what are the theme ideas and the big macros for 2023. It's so good to have you back together in the studio after 2 years.
Yes, my pleasure, Nikun.
But Voyage, we are not coming together as a family this time. Why is that? We're still doing digital this year.
No, we are doing digital because economy just getting opened up. I think when we planned, naturally people are not sure about how the opening economic trade is going to work. So we are planning to do digital. But again, we are going to take this to the all India level, and more at the regional level Voyage we will do once we are done with the session in the digital format.
You know, I've been associated with Voyage personally for the last 5 years now, and what started as a thought has now become a mission and more like a journey. We managed to change so many lives. We look at the numbers, which in terms of the mutual fund industry generating, the fact that FIs are selling and markets are still not falling is all thanks to the wonderful work the mutual fund industry is doing.
Even FM has made a comment today about that
Actually, I asked her specifically when I met her, I said, look, are you worried about a bubble in the stock market? And she said, no, I think this is the new asset allocation which is coming in now.
Exactly.
So Mahesh, just when we thought that it's going to be another great year, there is a war. Fed is going to increase rates. And if that was not enough, oil at $100 plus.
Sure.
How will anybody make money in this kind of an environment?
You're right. In fact, at the beginning of the year when we came with the outlook, right, very positive in terms of at least India growth story playing out, because I think it's time for India after a long time is what we thought. And positive, we're just coming out of the COVID impact. But yeah, I mean, a lot of things have turned a bit adverse, both on the global front, even what's happening in the geopolitical situation. So that has left some kind of a scar, and you would see some downgrades to global growth and also probably some downgrades to earnings. But I think this is again transient. I think the fundamental story of India, which is kind of shaping up and pretty strongly, I think that's not going to change. I think what this turmoil has showed that India during this period, normally with oil at around 120, right, you would have seen the currency fluctuate like anything, right? And we have managed this situation fairly well, and that shows that India has now emerged. I mean, it was one time emerging market, right, which had these twin deficits. But in this current resilience, I think it gives us confidence that if we can manage in this turbulent time, then once things ebbs, and surely it will happen, I think it will emerge much stronger. And I think that's what I think investors should be looking at. Valuations are a bit expensive. Probably this year would be a challenging year. We will not make very great returns. But I think over the next 3-year time frame, as the GDP growth comes back to around 6.5%, which is the long-term average growth which we think, I think corporate earnings in India would still have a very healthy growth in the next 2-3 years. And markets should really track earnings growth, even if there is some amount of P derating, right, because of the increase in interest rate. I think you should still make decent returns from here.
Bala, for the first time, we are discussing war. We are discussing, is this the end of globalization? Is there going to be a recession? If interest rates they go higher, what will happen to demand? These factors perhaps have not existed together in a long time. Right. And typically when you have these factors at play, the future outlook is about no returns, not low returns. How would you defend this?
I think it's interesting time in which we are living today. I think what was said and done, the high level of hope and optimism which is getting back on the back of economic trade, opening up of the economic trade happening. I think worldwide, I think as the economy get opened up, tourism will pick up and the growth will come back. Then naturally, of course, the war has put folk on the whole stuff in terms of that how the growth can get derailed. But having said that, even as you rightly put, the Fed has started raising interest rates. There is an worry of inflation. But one good thing that has come in the last few years, especially from India point of view, I think post the lockdown announcement, the series of steps that are taken by both the central government and the Reserve Bank of India in one, considering providing liquidity on one side, and focused on increasing the spending from government to drive back the growth. I think that aggression that I think gave them a great understanding of how economy can be revived, how the demand can be brought back. Therefore, having seen that kind of scenario for the last 2 years, and also having seen seamlessly the way I think the interest rates environment can be built in the country, I think my own belief is even going forward, though there are worries which is coming in, that we must also remember the fact that whatever the inflation worry that is there today is more driven by supply side constraints, not on the basis of demand side constraint, not on the basis of the high demand is coming in. It's all about supply. Therefore, even many of the manufacturers have taken a halt in the production because they don't want to burden the consumers with high cost on the goods that they are producing. Therefore, the policymakers now coming together, even if there is a marginal rise in interest rates, will not do any harm for the economy given the fact as interest rates start rising, my own belief is the demand for money in terms of borrowing will pick up, and most of the companies have been announcing capex worldwide. Probably as we start seeing this price getting stabilized, interest rate starts marginally moving up, you will see corporates jumping and then borrowing and then start focusing on capex announcement very soon. I think we are probably in a unique scenario where maybe the rate of growth could be marginally lower than the inflation rate. We can probably call it a stagflation, but not necessarily I think it's going to derail the overall revival of the growth in the next few years. But I think from India point of view, I think very well poised for two reasons. One, India is one country where there is a lot of political stability. And second, we are also producer of commodities, therefore we get the benefit. Currency being one of the more stronger points, the export-driven companies will continue to benefit. Last but not the least, the government continues to keep a very high focus on reforms in order to ensure that the economy come back to normal.
Mahesh, market price is a function of EPS and PE. Now the PE re-rating has already happened. EPS, if at all, because of margins, inflation, demand pressure, will come down. So if EPS is not going to go higher, and if PE will come down, how will one get returns? You're talking about low returns, but I'm talking about no returns.
No, so what you're looking at is this year, no? Okay, because of
the FY23.
Yeah, FY23.
Okay.
Because of the increase in the commodity prices and to some extent some disruptions, you could see some downgrades to earnings for, because this year, if I'm not mistaken, we are looking at around 17% EPS growth in FY23, right? So that can get impacted by around 3-4 percentage points is what our belief is, though market has still not factored in. You could see that after the first quarter numbers. But despite that, we are still seeing a double-digit earnings growth, right? And I agree with you that PE multiples will not re-rate. In fact, we are assuming that they could probably de-rate a bit because as interest rates go up and because of the current situation, geopolitical situation, you could see that. But so this year would be a year, anyways, in the early part of this calendar year, we said that this is a period of normalization, right? We are seeing policy rates normalizing and multiples could also probably normalize. Earnings growth, which was strong, probably that comes down a bit. So you could probably this year returns might not be that great, but I think going forward, because see, if you look at if your earnings GDP growth goes back to around 6.5%, nominal GDP growth around 11%, there's enough room for earnings to reflate over the next 3 years because earnings are still depressed. If you compared to what the average profits to GDP ratio, they are still depressed. And during COVID, what we've seen is that many corporates have actually improved their efficiency. There could be short-term impact because of commodity, this thing. But once you come out of that, I think there are enough levers for companies to expand their margins. And large sector like banking, for example, right? It has gone through a huge amount of problem in the last 3 years. We have seen the corporate NPA cycle at its kind of bottom now, right? So given the fact that credit growth also is like to pick up, I mean, last year we had single-digit kind of a growth. Expect that to be in double-digit. So I think if you combine all these factors, then next 3 years we think earnings growth can still be around in the mid-teens, right? So even if there is a derating of multiples, I think one can still make reasonable returns over the next 3 years.
So it's like saying that if I have to go from Bombay to Pune,
yeah,
this year could be I'm stopping at Lonavala for a vada pav. Year of no returns, right?
No return, you don't know, right? Because markets can still surprise you, right? And we've seen that, right? Despite all the negativity which you talked about, markets are still resilient, right? And climbing the wall of worry, as they call it. So I think India probably
haven't they climbed enough walls?
I know. You wonder how many walls. But the fact is that India, I think if you look at within the emerging markets also, what's happening right in China, Russia is totally out. Brazil is still a commodity driven. So I think India is a market where investors will come in for long-term growth, right? I'm not talking, forget about next 1 year, but if somebody has to put in money for the next 10 years, I think India is the place. And given that, I don't think India will become, you won't get it cheap, right? Anything which has got a good long-term growth visibility, you won't get it cheap. So it will remain a bit expensive, and you have to really buy in. I think there will be volatility, there will be, last year was a very good year, this year could be a period of consolidation, but yeah, one has to take that in the stride.
Bala, the positioning of India at the beginning of the year was that, okay, best earning story in the town, but the most expensive market.
Correct.
Great time for Indian businessmen, but markets are pricing in a lot of good news. So while I agree with Mahesh when he says that, okay, the long-term picture is looking solid, everything will start moving up, don't you think the valuation at these juncture are perhaps already factoring in an FY25, FY26? The fact that we've not fallen, Bala, is because markets know that FY23 may be a dull year, but 24, 25 will be a good year.
Yeah, I think if you look at the market for many number of years, it'll go through the cycles.
Yeah.
It always starts with something that completely is gone, everything looks dark, earnings of the company is going to be very uncertain. We start from that period, which maybe lasts for about 10 to 12 months. Then we get to the hope and optimism phase. That's actually the longest phase of the market, where earnings takes time to come back, and then hope and optimism continues to remain. Where we are today, I think hope and optimism still remains, and some element of growth is, I think, is coming back, not as much as what we are expecting. But then comes the growth phase, then I get into the completely optimism phase. The growth phase is the one where the EPS growth comes back, but the PE expansion doesn't happen. Whereas in the hope and optimism phase, PE expansion happens very significantly, and then earnings comes back a little later.
So we're in the growth and growth phase.
We are in the growth and hope and growth phase. We are in the in-between. Still hope remains from the point of view of policy making initiatives the government can take or Reserve Bank of India can take to support the economy. High liquidity, low interest rate regime, and inflation, of course, as long as spread across over a period of time, should not hurt the actual economic growth. And I think policy reforms, I think, should continue from the government point of view. And that being the case, I think supported by good monsoon, the rural economy, I think, driving the growth back. In all probability, India will probably stand out different from most of the global economies. I think the point what Mahesh mentioned about, I am also equally bullish this year. Whole of last year, we saw almost about $20 billion of FIs outflows. Yeah. And not necessarily in the year 2022 or 23, a similar kind of trend would be existing, given the fact that China and Russia, as Mahesh mentioned about, they are going through their own tough period. Therefore, India would probably stand out very differently for getting FPI flows and FDI flows. Therefore, the growth supported by earnings growth coming in, maybe even if it get delayed, but it's not coming in denied completely. As long as that's being the case, I think we'll have to look at market more from the medium to long term point of view, rather than looking at the 1 year outlook, where the 1 year outlook, there will be a lot of challenges, no doubt. And that's something I think as in Voyage, annual Voyage, we actually paint a picture for next 4 or 5 years of future. But at least we must know what's happening. That's why actually we have been doing this event. And hopefully we should be able to bring that out very clearly on the table.
Okay. Mahesh, another point which everybody wants to perhaps understand is that why are we getting such magical numbers from domestic institutional investors? Whatever FIs are selling at the end of the day, that same number is bought by DIs. Now DIs have limited money or kitty. It is believed that funds which you manage, they hardly sit on cash, fully invested by and large throughout the year. So where is this treasure coming from? Alibaba, Chalis Chor, what is that khajana? Every time markets go down, FIs are selling, DIs are buying.
So if you look at while the flows have been fairly strong in the last 1 year, and if you look at the penetration, of say ownership of equity is still very low, right? It has gone up from 3% probably to 4.5%, 5%, but still it is very low, right? So, and the way in the last 1 or 2 years you've seen the new investors who have come in, the number of new demat accounts which have been opened. So there's a whole new set of people who have come into the market, which are coming for the first time, probably taking a longer term view. So my belief is that, again, the alternatives also, right? What are the alternatives with interest rates still low in our economy and inflation still on the higher side? So how do you really hedge against inflation? So given all these factors, I think the steady flow which is coming into the market through the mutual fund route, especially SIP, is likely to continue. The direct retail money which is coming into the market, right, which has come in, kind of speculative, a lot of first-time investors coming in, chasing some of these stocks, they might see some kind of a disappointment this year, right, because you've seen stocks correcting also big time. So that can be a bit volatile, but I think mutual fund flows should remain fairly steady. And that, I think, is a big change in India, right? Despite, as Bala mentioned, despite $20-25 billion of FI outflow, we have still been, markets has not really corrected. That shows the kind of balance, which has been created, which is good from a longer term structural for India in terms of, I mean, markets finally are
What happens when both of you are buying, which is FIs are buying and DIs are buying? Then it is actually bad news, right? Because that will create a bubble.
Yeah, I mean, it could happen, right? I mean, you've seen that in other markets, right? Okay, when liquidity, there is one other liquidity, another factor which can take the multiples higher. We saw that what happened a year back, but it could happen, right? So that's why in the market, India, probably we expect that the P multiples will again come back to the long-term average. It might not happen, right? Multiples will remain expensive because, again, it's kind of a TNR factor, and again, everybody chasing the same markets. We don't know, right? But we have to be more pragmatic and make an assumptions based on more realistic multiples. But yeah, that could happen when things normalize. Okay, after all this, I think India could be a market where everybody wants to chase, right? And you might not get, I mean, you might expect the markets to correct from here 10% and make it cheaper, but that's the way it is. So I think that's why we invest. It's look at the long-term picture. As long as the picture is good, don't get too worried by the short term. If at all there is a correction, it's an opportunity to really invest is what we would look at.
So this year is more like a pit stop at Lonavala. Next 2-3 years we'll reach the final destination, which is Pune. That should be the ideology.
Yes.
Okay. Bala, one very basic question which we've not discussed on any of the previous occasions of Voyage, because that concern was not there. In Hindi, if I may say so, महंगाई की मार. The inflation is hurting us now. What should one do to ensure that your pricing power does not come down in an inflationary environment and you are not losing your basic principle? What is the best asset allocation? How can you make your portfolio inflation proof or inflation insulated?
Correct. I think interesting, Nikun. I think if one looks at equity investing, it's supposed to be an investment, take care of your
future purchasing
power.
Yeah.
It's as simple as that. And that's being the case today, if you look at from a common investor's point of view, or even the HNIs, or even the traditionally focused more on investing in bank deposits. For him, any bank you go, you get about 4.5 to 5% or 6%, maximum 6.5% you'll get if you're a senior citizen.
Yeah.
And none of the banks are going to raise interest rates, even if the Reserve Bank of India is going to hike the interest rates.
So much of liquidity.
So much of liquidity, demand for money is not there. Therefore, from an investor's point of view, alternate investment becomes one of the key option to look at. Second, of course, as you rightly asked the question about inflation, fortunately, of course, the goods prices in India is still not rising, except the oil prices have gone up and diesel prices have gone up. We still not have seen a widespread increase in prices. Let us just assume in scenario the price goes up. Ultimately, the price increase, it benefits some of the companies who are producing those services or the goods. Therefore, they make more money, as we have seen in the last 2 years, how metal companies have revived their profitability completely just because of 1 or 2 years of good pricing power they got on their metal production that they have. I think similar thing will go through for every company. But from a consumer point of view, the best way to protect you from the inflation is actually look at equity as an asset class. But having said that, as we all discussing about volatility could be there, therefore one has to actually learn to ride the market more in the long run. In that case, if you look at it, I think the balance advantage fund, which have a good mix of equity and fixed income, we can call it an asset allocation fund, where the money manager actually takes a call on where to go on long on equity or long on debt. That's also something I think could be more useful from the investor's point of view, to go and park your money and then actually look at it from a longer term point of view when you want to move the pure equity between the large cap and the flexi cap funds and the mid cap. You can consider the portfolio as you come in. I think what is most important from investors' point of view, come and park yourself in balance advantage fund kind of model and then spread your wing as you want to build your portfolio over a period of time.
Mahesh, so very basic question. Voyage is about understanding the trends, understanding the medium term picture and the challenges, and understanding the long term asset allocation. So we are talking 3 to 5 years now. What to your mind should be the projected returns from debt, a corporate some of your corporate funds, let's say a balance advantage fund, and a mid cap and stroke small cap fund?
So I would say that, I mean, if you take a next,
3 to 5 years.
Okay, 3 to 5 years. I think 3 to 5 years, more or less, I think the rates should converge, to what the long-term rates are, right? I mean, at least for the next 1 year, we are not expecting any great returns on the debt side because
interest rates will go higher.
Go higher, right? Even if you're able to balance the maturity, it will be somewhere around 6% or so. So that's where we are. On the equity side, if you look at, on the other hand, I mean, looking at our view on earnings growth and some normalization, I would say kind of a 10 to 12% is the return.
We are talking about CAGR returns.
CAGR returns, okay. Yeah. I mean, it's not a great return, okay, compared to what people expect, but I think that's still a good return in the context, okay, where we are. Because as you rightly said, the market is not exactly cheap, right? We are buying it on the higher side. And funds should be able to probably give slightly higher returns. I think mid cap, small cap, I think while mid and small caps have done well in the last 2 years, at the moment they look a bit vulnerable because of the current situation. But if India grows, right, then a lot of small companies, mid-sized companies would also do well over the next 3 to 5 year time frame. And one can expect slightly better returns, okay, than the market returns. So I think if you're investing into coming to a mutual fund route through a balance of say a large cap, multi cap or a mid cap kind of a basket, then I think one can expect another 1 or 2% higher return than the market returns.
Which almost on a 3-year basis, Mahesh, would be double that of inflation. That's the point which I want to bring out, that inflation will also start normalizing on a 3 to 5 year period.
Right.
If you think that equity could give 12 to 14% return, inflation I'm sure is going to be adjusted inflation, it will be almost double of that.
Right.
Broadly speaking.
Yeah. I mean that's what equity longer term, if you look at it, right? Okay, equity returns and the inflation in the country, it's been around that range.
So which is a fantastic return.
Which is a good return, yes.
Which is a fantastic return.
Yes.
Bala, when you speak to distributors, and we've got some distributor panels, like always look forward to those panels. You get so much of understanding of what is happening. When you speak to your distributors, what are they telling you? I mean, are they getting a sense that the new investor who's come post-COVID and has had an honeymoon period, because if you came in 2020, whatever you touched after the fall has turned gold, and 2021, whatever you didn't sell has, if not become gold, it has certainly stayed silver, right? Now the temperament is tested because volatility, war,
Correct.
macro, it's challenging you. Do you see that the new investor who's come here is here to stay, or the temperament is getting checked? March was a bad month. March the slowdown started impacting in terms of inflows.
So I think from a distributor's point of view, the current volatility has given them an edge in terms of getting higher recognition. For one simple reason, the last 1 year, though all of us were very happy, a lot of investors have come into the market, first time investors came in the market. The fact of the matter is they all came to the bull market. They have seen a complete rise in the market. They also have a significant fall in the market. There is huge participation we saw in the IPOs. And some of the IPOs have done well, some of the IPOs have done very badly. So I think this is where I think the investors have realized the importance of advice, importance of going and asking somebody actually what kind of asset gain they should have. Therefore, the number of queries that has been being received both at the AMC's level and the distribution level, I think has only gone up in the last few months, especially post the volatility. As you rightly talked about, after the market crash, post the Russia and Ukraine war declaration, clearly we saw a significant fall. So I think it took a lot of people actually who are the first time investors in the market. So I think making them realize the important asset allocation has now become the key. And this is why I think the distribution community now playing a bigger role. My own assumption is the last few months, given the fact that when the market fell, there is worry about the war, but still money came into the SIPs and actually touched the all-time high, which essentially means actually boosting the confidence of investors, invest in the market in a falling market, and through the asset allocation model to build a portfolio for the long term.
So Mahesh, before we wrap, let's understand the phase of the market. They always say markets follow a cycle, right? It starts with disbelief, it then comes in participation, earning expansion, complacency, then euphoria and a bubble. Where are we right now?
So I think it's slightly complex because there are so many external factors. But I mean, when we started looking at it at the beginning of the year, we were seeing that probably we're in the mid of, the markets probably had rallied slightly ahead of the fundamentals, right? But the catch up on earnings, if you look at economic recovery and the earnings, I think we were somewhere at the beginning of the economic cycle, right? I mean, even pre-COVID, okay, we were trending down, right? Somewhere around below 5%, then it came down. So things were kind of building up. So the economic cycle recovery was probably at the early stages, right? Earnings recovery probably slightly higher earlier because post-COVID we saw, despite the GDP growth contracting, actually earnings grew, right? Yep. So they were slightly ahead of that. If you take a sum total of that, right, I would say we are still in the mid of that cycle, overall market cycle. So there is still, I mean, as I said, no, it's still, I mean, journey is still half done, right, in terms of...
So the last phase is always the exciting phase, Mahesh. That's the time returns will be super nominal. Right. That's the time participation would be wild. That's the time you don't need a sip, but you will still get a tip in a lift. So we are not there. So the best in terms of an euphoric return is yet to come. Before the market
to some extent, there was some amount of euphoria, which was, to be fair, right, in the last, because again, in the last 1 year.
When the internet companies went wild.
Internet company liquidity itself, right, we saw, right. But again, it was slightly ahead the fundamentals. Now, economic recovery and earnings growth and all those things, I think that is yet to peak out. And that could probably, I mean, never know, but over the next 3 to 5 years. I think India's best is yet to come, I would say. And if somebody has to really see that, I think until then, I think one need not really worry. I mean,
Bala is saying this from 15 years, the best is yet to come. Kab aayega best ko?
So that's the beauty of our economy.
Every time you say best is yet to come.
Now that's the beauty. Because as long as you will continue to live in a high hope and reasonably good expectation that you are able to build, then you can
Bala,
hold
but
on to your optimism.
couple of years you'll retire. You have to see the best before you retire.
No, Nikun, in all fairness, I think India is still, it's called as the developing economy.
Right.
And until such time we become actually part of the developed economy globally, I think the hope and optimism for India will continue. And we can't look at a 1 year market, we have to look at a 10-year market. I still believe that we are probably in a 10-year of bull market in India, given the fact we still have a long way to go.
Mahesh, this is a conversation we had pre-COVID, one of the Voyage sessions, and I said, what is one thing you want Bala to do? He said, I want Bala to stay at home, spend time with his family. He stayed at home for COVID. He's come back to office. How does it feel? Boss is back.
Yeah, I mean, back to a normal day, right? Yeah? Feels good, I think. I think during COVID, I mean, while working from home was a different experience and productive, but I think you again urge back, you want to again urge back again, right?
Good or bad? Good or bad?
It's a learning. I think every phase, good or bad, I think it teaches you something, right? So COVID also taught you something sitting at home, right? But I think again you want to back with your team, right? And work together. I mean, that's where all the action happens.
You know, I must say that when it came to interacting with COVID, somehow with every fund manager, everyone we had on the show, early morning one thing was constant, cooker ki ghanti. You know what's cooking in the home.
Yeah, that's right.
Gentlemen, really lovely to have you back, and look forward to another rocking Voyage. It's a digital this time, but hopefully next year when we meet, it's going to be on the ground, and perhaps we should aim to host the biggest Voyage we've ever done together.
Exactly.
Thank you very much.
Thank you.
For the moment, it's back to the studio.